It's Brian Preston, the Money Guy.
Juliet asked this, and then Mark came in and asked something very similar to this. The financial order of operations has us paying off high interest debt in step 3. Is there a mortgage rate that would move it from a low interest debt category to a high interest debt category in the FU? Because then that low interest debt comes way later in the steps. Are mortgage rates always supposed to be low interest debt when it comes to FU? What do you guys think?
This is actually something we've been talking a lot about lately, because a lot of folks who have been working through the financial order of operations for the past couple of years, or even before we officially launched the FU, as we work with individuals that have been buying homes and owning real estate and that sort of thing, they've not seen a higher mortgage rate environment. They don't remember the days of, oh man, the reason that I choose a 15-year is not necessarily because I want to get out of debt quicker. It's because there's a big arbitrage between the 15-year and the 30-year, and that's how I should approach that. So I do think, Brian, a lot of people, just like Juliet and just like Mark, are wondering, okay, what classifies as high interest debt? And does high interest debt for you mean the same thing as high interest debt for me? Or does it change based on where we are life cycle wise?
Yeah, you'll have to rein me in if you want to bring in the technical stuff with risk-free rate of return, equity premium, and those type of things, because that's the stuff that goes into, and I know we've talked about the high interest debt versus low interest debt. But I also want to kind of give some context in the fact that, because I have been in an environment like this before, bought a house in an environment like this before, where I remember my first house, the mortgage rate was 6.75, and I thought I stole it.
And you were so happy
because
about
the
it.
rate was 7.5%, just like 2 or 3 months earlier. And here's the thing that I always want, the context I want to remind people of. There's going to be two journeys in your life of this financial mutant walk, and the fact that you've got your building wealth phase, and then you've got your keeping wealth phase. Mm-hmm. And building wealth is a hard thing when you're younger, because you have all the potential in the world because you have time on your side, but you don't. It's just not ensured that you're going to save enough, put enough money to work that you actually build that wealth journey. Mm-hmm. Now there's a point when you get to older, I mean, you've hopefully done the right steps while you're younger and had time, that you're now in this mode of protecting your wealth or preserving your wealth. And that's why we've always, in the financial order of operations, tried to keep those two things. You've got the risk because there's risk involved with both of those. You know, I hear a lot of financial commentators say you should always pay off your mortgages as fast as possible because that lowers risk. Well, does it lower risk? It lowers one risk. It lowers one risk, but there's still, I think it actually could raise the risk of that young person actually building wealth. And that's the thing. So I have to go back to young Brian buying his first house at 6.75, feeling like that was a steal. Guess what I was still funding? I was still funding my Roth IRA back then. I was still contributing to my employer's retirement plan, even though I was trying to get into this first home that was at a much higher interest rate than what we've come to get used to with 2.5%, 3%, 4%, whatever we're talking about here in the last decade. But because I had the thought, and we just showed a stat on a show we recorded, that historically, even from 2000 all the way to 2022, taking inflation into account, or was that 1980? What was that? I can't remember. Was it 2020? Was it 2000 or 1980? Mm-hmm. Historically, S&P 500 has provided an 8.98
since
1980. So that's even better because there was a lot of inflation in the 80s. An 8.98 rate of return above inflation. Mm-hmm. That's powerful. That's powerful on that building wealth journey. So even though interest rates are higher now, I'm still telling you, as a young person, you will have to make sure you are still saving and investing to build wealth for yourself. So the technical answer is, of course, there could be a threshold where if mortgage rates were 15%,
sure,
it's hard to call that low interest. Mm-hmm. But I got to tell you, on the context of understanding inflation, equity premiums, the S&P 500 showing from 1980 to 2022 is 8.98 above inflation. Mm-hmm. We're still in the context that it's still super important for you to start investing to cut off the risk of that you won't have resources in the future. And yes, it's going to hurt to have that mortgage that's charging you 6%, even 7%. but it will work its way out. You will have the opportunity to refinance down the road. Because, by the way, the federal government can't afford to pay these rates forever. They can't afford to pay the interest on all the debt they've run up. So they're reloading the spring to drop rates in the future to stimulate growth and economic things. So you will have the opportunity. But right now, I still think mortgages are probably in pretty comfortable ground to stay in step 9 of the financial order of operations.
Yeah, the technical thing you have to define is what is the risk-free rate out there in the marketplace. You got to define that. And then based on your age, you have to define what is your equity risk premium, what's your long-term expected rate of return. What's great about history is we can go test ourselves. Do you remember what year was it that you bought that first house?
1998.
1998. So I want you guys to think about this. Brian, as a young lad, had the decision to make. I can either take $1 and go satisfy a 6.75% mortgage, or that same $1 could go into a Roth IRA or go into my 401k or go into fill in the blank. Well, we know the rest of the story. We know, even though at that time Brian was buying towards the top of the market, because we know the dot-com bubble burst. If you look at what that $1 did from 1998 until what it's done now, at the age that he's at now, it'd be hard to make the case that it would have been more advantageous to pay off that mortgage or to prepay even that 6.75%. So if you can define your own equity risk premium, you can figure out in your situation what is high interest, what can I not go out and earn in the marketplace above and beyond I'm paying an interest, and what's low interest. My dollars could be better suited, better used somewhere else.
Well, I'll take it a step further. I've actually, because I'm old enough, and I haven't done everything perfect. That's what I love about the financial order of operations. That's what I love about money. Is you don't have to be perfect. You can make a lot of financial mistakes and still be very successful. When I started my company in 2002, unfortunately, food got squeezed in a lot of places because I was just trying to pay the bills, trying to get business. I was burning through cash left and right for the 3 years it took me to get this company up and going from 2002 to really 2005. And I've calculated, now look, it's not the same as that 1998 period where I paid 6.75, but I've calculated there's $10,000 that I missed out on with Roth IRA contributions. They'd be worth close to $60,000, $70,000 right now based upon the rate of return I actually earned in my Roth IRA, depending on which period you look at. And then I extrapolated that out to when I retired. If I took a traditional 65, that number could easily be over $500,000 just from a $10,000 mistake. So these numbers, like I said, you have two components here, and you always have to have the context of there's the building wealth phase, there's keeping wealth phase. Do not, for the perceived comfort of paying down interest on mortgages that are, in my eyes, still low interest debt, miss out on that exponential opportunity, because things don't grow linearly. Over the long term, they grow exponentially, and you can't even fathom what your future self is going to look like if you start doing these things at an early enough stage and have time on your side.